Good morning, traders. Today is January 28th, almost the end of the first month of 2023. And boy, what a powerful move we've seen in the markets. A lot of people were not expecting this move. If you've been following my research over the past 4, 5, 6 months, you already were aware of the setups and you should have been profiting very nicely from this move up in technology and in the SPY, and in a number of different sectors, particularly gold as well. My name is Brad Matheny. I run MENT.com Technologies. I've got almost 30 years experience building customized quantitative modeling systems, trying to understand the markets and trying to pick apart, great opportunities for trader. This is my website, MENT.com. Please take a look at it. Please see what I offer. I like to say, I do the research, you make all the decisions. As far as a trader is concerned, I'm out here trying to help you every day and every week, try to find the best setups, the best solutions, protect your capital, become a better trader, improve your research, deliver clear, actionable trading signals, and show you how I am different from everybody else. So I offer basically one subscription called the Expert Growth Membership. It includes everything, including my incredible SPY cycle patterns, which are daily predictive Japanese candlestick-like types of patterns that have been just rock solid. I don't know how to tell you or how to explain this to you, but I have spent months trying to map out predictive technology on the SPY. I'm working on gold and QQQ right now. These are daily predictive patterns that are roughly 80 to 90% accurate, if not more. They are designed to help you in your own trading. Understand that if you're trading options or futures or CFDs or what have you, even the raw underlying ETFs or equities, the idea here is that you can determine what the market is likely to do 2, 3, 4 weeks or months in advance, and you can then plan your trading accordingly. On top of that, I have incredible solutions. We're going to go through some of them today, making changes to the website. So a lot of this free content is going to be at the middle of February, end of February, shoved into the Expert Growth Membership. You're not going to be able to get it on YouTube and on some of the other free sources. I've been giving my research away free for about a year. I want to try to attract as many people to show you what I'm capable of doing. This takes a lot of work. I maintain live data services. I maintain servers. I provide all of this data for you on a regular basis. And like I said, I'm charging a very small amount for what you get. You get all of my services in one product called the Expert Growth Membership, and I'm trying to make it as cost effective as possible. So visit MENT.com to learn more. Now let me show you some of what we actually get here. So first off, you get the live trades setup. Live trades is where daily swing trades take place, and I was just doing an update on these swing trades yesterday for members, and I want to highlight how some of these modeling systems work. So we're looking at the 3x4 and ETF rotational all setup, which is this rotational modeling button. Live trades works as a standard mode trading system, which means in and out, targeting strategic 2 to 15-day trades, or a rotational modeling system, or you can select just show me newest triggers, or you can select what's called pure alpha, which is newest triggers ranked by what I call pure alpha technology, which is a proprietary ranking method. What I'm focusing on right now to show you is the rotational modeling system. The foreign indexes have been doing extremely well over the past 2 or 3 years. Lots of big moves as the dollar strengthens and the markets weaken. And we're very likely going to be seeing foreign markets continue to move in, 20, 30, 40% or more over the next 2 or 3 years. So this is a resource for you to come and look for trades. You have 2x ETFs, 3x ETFs, stock lists, NASDAQ, Reddit, hot shots, and then my core indexes here. And you have futures, then you have currencies, then you have available resources, and of course, contact us takes you to the contact page. But take a look at some of these trades. So CQQQ, a trade of about 3 months ago, is up 35.5%. EDC is a trade of about 3 months ago, is up 55.25%. EDZ of a trade about 3 months ago is up 40%. Now stop and think about these numbers, folks, okay? And this is the rotational modeling system. So when we get into big moving markets, these types of setups can be, I mean, tremendous. I don't know how to explain it to you. These types of moves can be tremendous, huge moves. I mean, one stock moving 40% over 3 months is just is incredible. EFA is moved 19% in 3.5 months. EFG is a new trigger about 3 weeks ago, is up 4.58%. EFV is 3 months old, it's moved up almost 20%. EURL is about 3 months old, it's up 66.09%. I mean, really, guys, stop and think about this. How much is this worth to you? Is this worth 20, 30, 50, 80, $100 a month to be able to come in here and catch some of these easily addressable swing trade triggers? Especially, you know, you get into things that are, you know, let me show you down here near the bottom. So KORU is up 53%. MEXX is up 23, almost 24%. This is a newer trigger. PID is up 4%. This is still technically close enough to get you can still get in with moderate risk because it's newer. SCHF is up 4.65. You could still take this trigger because it's newer and it hasn't rotated around so much. But now take a look at some of these down here. Okay, let's get down into this Yang. Huge move. I mean, literally 70% in 3 months. Yin, 82% in 3 months. I mean, these are huge. And like I said, these rotational modeling system triggers, they're available on everything. So you come in here, you go to the NASDAQ, you go to rotational modeling system, and here you have all of the NASDAQ in a rotational modeling mode, giving you almost unlimited trade opportunities every week. So now let's take a look here. They're always sorted by some of the newest triggers up front. So here we have Apple from January 20th is up 5.1%. ADI from the 27th, which was yesterday, is minus 0.12. ATVI from about a week ago, a little over a week ago, minus 2.8. Remember, rotational modeling systems ride through some congestion, but catch bigger, broader market trends. So here's some newer triggers are minus a little bit. That happens. Cost is plus a little bit. Trigger was just 3 days ago. CSX is plus 20. Let's come down and take a look at some of the older triggers. So we get down here, we start looking at HAS as about 2 weeks ago, minus 9%. HOLX is 23%. HSCI, 3 months old, is 22%. IDXX is about 3 months old, 33%. ILMN looks like it's down 12% right now. INCY, 21%. INTC is long from just about 2 weeks ago, is minus 4.5%. And you can see they're just unlimited trade triggers. That's what I'm trying to show you is with my guidance, with my weekly updates, with all of my data, what I'm trying to do is show you how you can come in here, execute trade triggers very quickly, very easily. Wow, look at this, MELI. What a big move. It's only really 2 weeks old. It's up 33%, 2 weeks old. Incredible. Monster's been tracking very well. It's up 8.9 or 9.88%. This is Micron, I believe. MU is up 13%. Netflix, a trigger from 4 months ago, is up 34%. NTES, a trigger from 3 months ago, is up 29%. Wow. And again, these are just here waiting for you. This is the live trades algo ready to go. Okay, so now I've covered everything. Now, part of what you get here, I'm going to show you here with the when you log in and you go to the Expert Growth membership page, this is what you get when you sign up. You get not only live trades, but you get the Expert Growth membership. And remember, under this, you can still get to both. You have my updates pages, which is part of this week. I'm doing the updates. Member resources, video analysis here. You also get custom indexes, which I post up every Sunday. You also get the hot list, which I post up every Sunday. And then you, of course, get the Trade Tank message board, which is where I go out and add comments every Sunday and provide the SPY cycle patterns for you to review. Those are the daily cycle patterns. Under member resources, we have trading support, general support, FAQs. You have a getting started video. You have an expert growth worksheet, which is about 7-8 pages of content to help you understand how to use and plan and trade efficiently. And then we have a sample portfolio that we're tracking on a weekly basis based on these TT scanner setups. Again, this is very inexpensive. It's designed to help you. It's designed to be your primary source for trying to find and grow and gain experience to become a better trader, as well as to manage your resources in your retirement account. For example, this rotational modeling system here is the basis of all of my long-term. This is my core strategy and my long-term strategy for investors and everyone who is got money in a 401k or an IRA or retirement account. You can see here it's performed extremely well compared to the SPY. We almost got back up to new all-time highs in 2022. We're about ready to really rock into 2023 with a new trigger. This is the basis of the actual growth model for all investors, for everyone who's trying to manage their retirement account and trying to beat the SPY. It does go through periods of drawdowns. I'm not lying. You're going to see periods of 8, 9, 10% drawdowns periodically. But ideally, this has been extremely consistent. Remember, this is going back from 1996, prior to the dot-com bubble, prior to the global financial crisis, and prior to all of this rotation, which is 2018-19, then COVID, and now 2022. So this has withstood, 26 years worth of data, and up and down modes in various types of trends. This has performed extremely well, as you can see. And this is, again, if you want to try to beat the S&P, if you're just starting out, if you don't know what to do and you're trying to manage your money, this is the core element for you to focus on as you learn about my other resources. Then beyond this, we go to the hot list, which are weekly swing trading systems. We go through my custom indexes again, which it shows you what to expect in the market. For example, this is the U.S. to Global Market Comparison Index. Global markets are expanding quite strongly compared to U.S. markets. This is the Global Asset Market Index. We're watching and waiting for this to recover. This is the Large Cap Value. The Custom Volatility Index has moved back into moderate bullish trending territory. You learn all of this by watching the videos, okay? So pay attention as we go forward. I hope you enjoy. And please consider coming and joining the Expert Growth membership. It really is worth what I'm charging you. And again, it's a real value. Okay, let's get going here. So now, this is an SPY weekly chart. I always focus on the SPY weekly chart because that's where the rotational modeling system is focused, and this is what we want to try to understand from a general market standpoint. Ideally, the market is multi-layered. So we can't just rely on the SPY, but we can get a pretty good basis of market trend based on what's going on with the SPY following my custom indexes. So I've moved and extended these support boxes out here. I've moved and extended these intermediate support and resistance boxes here. This is a weekly chart. This is COVID. This is the rally up into 2022, early 2022, end of 2021. And this is the big sell-off that we just experienced with this recovery phase here. Now, what's happening, ladies and gentlemen, is we are moving into a fairly early stage recovery right here. We have not yet moved into confirmed bullish trending. We still need to be cautious, okay? And I'm going to explain this to you. My analysis over the past couple of months has been that we have reached a peak. We've come all the way back down in a solid 5-wave format, reached the bottom, which I believe is the end of wave 4, at least for now. This looks like the end of a downward wave 4, and we should begin a new 5-wave to the upside. I have been calling for this new 5-wave to the upside and for bullish trending for quite a while, even through this rotation. This was expected, and now we're back up. Everybody, well, not everybody, but almost everybody that I've been talking to has been super short. They've been telling us that, this is it. The Fed's going to blow everything up. We're going to end up in the Great Depression again. And I'm seeing us move into kind of a sideways flattening channel. I see the U.S. markets moving into a consolidated upward trend through 2023, possibly moving back up into this area, and then maybe in late 2023, early 2024, moving back towards new all-time highs. It really depends on what the Fed and the global central banks are going to try to do. I believe the Fed is going to come in softer over the next couple of quarters to see what's going on with the market. I believe the inflation trends and the GDP numbers are within measure, will probably be revised a bit over the next 4, 5, 6 months. I believe we're in at this stage, an early soft landing type of scenario. And until something breaks, I don't believe we're going to see a massive downside move. Now, the Fed could come in and, disrupt the market, raise another full 100 basis points, or there could be some global crisis event with a financial institution or a bank or even a foreign government or the U.S. government. But I believe that with the amount of money printed over the last 7, 8 years, and the fact that the Fed continues to have ample tools at their discretion to try to manage the effectiveness of the economy, what they're looking for is 2 things. Number one, inflation to start to subside. Even if we get a little bounce after getting fairly low through this deeper downtrend, I believe that they've got enough pressure on the economy and the markets with interest rates the way they are. They basically want to try to let the choppy waters settle, which is going to basically be 2, 3, 5 months of letting it settle. Now, 2024 is an election year, so we are moving into a 18 to 24 month election year cycle, which typically is very flat. Let me show you here. Now we go back to monthly. And I'm going to try to highlight here. So we had election year in 2008. I'll just kind of draw this. Election years tend to be flat. And then we had an election year again in 2012. And then we had an election year in 2016-17. Then we had an election year in 2020. Which is this time frame, 2018 to 2020. And now we're in election year over here. Now you can see volatility-wise, 2020 got a lot more volatile than 2016, 2015, a lot more volatile than 2011, 2012, and a lot more volatile really than 2007, 2008. So where we're at right now, if we were to come back over here and project election year volatility, we'd probably be looking at something kind of like, well, 2024's election year, so to right about here. So we have an approximate here to here. In here, see if I can find that line. should be down here at the bottom. We have an approximate 15.35% range. So understand that in this election year, going forward the next 18 plus months, I would expect roughly a 15% upside price range from recent lows. That would put us at about a 22 to 25% downside range. And I need you to understand that this is what happens during an election year cycle. We end up in a sideways range, especially once the broad election campaigns start to kick in. It sends the markets into kind of a broad sideways. We're going to wait and see what happens. There's all kinds of news, a lot of surprises. So that puts the markets into kind of a sideways mode. You can see it's happened repetitively. 2015-16, the Trump-Hillary election, markets went completely sideways, pulled back about 18-20%. Over here, 2018-19-20, the Biden-Trump election, we had a lot. This was obviously COVID. Well, this was 2018. And we come into 2019, and we come into 2020. We had some rally phases here. We might see some of that this year, but we need to expect some wide-ranging volatility here and really neutral trending. So now, as we come back to the weekly chart, I'm going to try to tell you again that we need to stay very cautious. Let me get rid of this window. We need to stay this is the range that I'm expecting in place throughout the next year. We need to stay very cautious and watch about these resistance levels. So you can see I've drawn this big red area here. This 410, 420 area is the next level I think we're going to target. But I think we're going to run into some resistance here. And again, if we take a look at this, we have a good solid bottom here. We have an A wave up, a B wave down, a C wave up to here would not be uncalled for. Then we could see some sort of congestion before we attempt maybe a deeper downside move. And then we might see some up and then possibly up into the end of the year of 2023. That's kind of where I think we would be. This would essentially be a wave A. We have wave A to here, and then a wave B downward move, then a wave 1 of C. Remember, wave A can never be the longest wave. So C or D typically have to be longer, much longer than A. So if we get into this move here, it would not be uncommon with an initial wave C here to pull back and then extend higher. And it basically would give us a wave 1 to the upside, wave 2 to the downside, wave 3 to the upside, wave 4 to the downside, and then a wave 5 up. That would be just wave C, the middle wave, meaning we could extend even higher. But right now we need to watch these areas, these 410, 420, 423. That's where I believe we're going to run into some major resistance, and I believe we're going to see the market stall out, possibly come back down into this 402 range. Remember, the bears will be screaming. The bears will be screaming, it's the end of the world, it's the end of the world, you got to sell everything, it's going to dump. And again, I don't think that's really the case. I think we're kind of migrating out of this into a sideways mode into the end of the year. Remember, the end of the year is right over here. So let me try to draw it here. And here's November. Here's the end of 2023, beginning of 2024. And this is about where I expect the markets to be. SPY is about 450, 440, right in that range by the end of this year. This would be just a solid little melt up, sideways trending within some consolidation. If I were to try to understand the consolidation range, I would try to essentially say from roughly, this is just visually, guys, from roughly this area and I'm going to try to make this a little bright and style, dashed, thick, okay. Let's make it a kind of a darkish color. And then let's duplicate it. And if I were to pick a range, it would be something like this. So between these dashed lines here, this is what I expect essentially the markets to do. You can see how that falls right in line with my blue drawing. It stays right in line with my range factor. So considering this is the lower channel, this is the upper channel up here, this basically shows us that we could consolidate into this range going forward. And again, this is assuming there's no major crisis catalyst event. Okay? All right, so now I've given you the general impetus of what I believe is going to happen in the markets. Remember, we're going to run into resistance around 410, 412, 415 right away. So we're going to, if we see an upward move here, we've got to get above this 408, 409 level, and then we're going to run into resistance right over here at like 415, 412, and that's going to probably stall out the market. We could attempt to blow right through it, but then, like I said, I think we'll get a pullback. Once we get up above, say, 420, 421, 422, I think we're going to be looking at a pretty decent sideways pullback before we start another upward move, okay? So the rally phase here looks like it's going to carry on into maybe February 10th, 15th, 20th, maybe. And then I think we're going to kind of stall a little bit as we move into spring and summer and see what happens. Okay, so now the custom indexes. Let's try to go through these. I don't want to be too long. So the custom accumulation phase index has rallied back up. This is the SPY, nice and solid here. I expected this to move downward. This is the custom accumulation phase index, which it is moving downward. So we're getting a good basing. I expect this to continue to kind of flatten out, move downward, which would prompt a little moderate floating upward here on the SPY. Very solid analysis so far after this peak. This was really the blow-off peak, and you can see here, we had this kind of a blow-off selling peak in 2018-19. Then we moved into trending. Even through COVID, right here, COVID, we moved into trending. Then we had this kind of a blow-off rotation, and then we moved into trending. Then through here, 2022, we moved into this blow-off selling down to a peak, and now it looks like we're going to consolidate back down here to this green line potentially, and that'll prompt an upward trend, a moderate upward trend. The custom cash flow index is moving positive. We are near the lower channel here. This is the COVID high. We are inching our way higher. This is really showing you the peak level here, but this is a standard deviation channel going back many years. We could see this reflate, but I really think we're going to kind of move into a sideways phase, staying in this 130 to 160, 165 area for many, many weeks and months. We will eventually establish off of this low a new trend, but I think we're going to see this being a lot less aggressive than this trend. So be prepared. We've seen kind of a reflation trade. I think we're going to stall out over the next couple of months, 35, 45 days, and then set up a base bottom, and then set up a new upward channel that we're likely to see continue higher. The consumer engagement index, big rebound. This is what I was looking for. Remember back over here, I was telling you that this is really wiping out a lot of consumer engagement to 2011-12 levels. And we got that bounce that I expected. I warned you that this level, this purple line, needs to get broken in order for real consumer engagement to come into play. We could, at this point, ladies and gentlemen, come right back up to this level where this purple line is, staying below this pink line, kind of just migrate right over into this area and stall back out again. That is a very real possibility. I think this is a reflation bounce. I think this is setting up kind of a move away from the downward trending that everyone, the doom and gloomers have been expecting. We are not out of the woods yet. I mean, we could still see the market break downward, but we need to see it build a base, build some momentum. And that gives us some time to really prepare and engage in the market in a different standpoint. This is not going to be a quote-unquote deep V bottom, in my opinion. This is going to be more like a 2002, 3, 4 type of bottom setup where, you know, it may take 2 years or 2.5 years to fully recover back up into these areas over here. So get ready. We could be in for a bit of a slog. Okay. Custom devaluation cycle phase index. This is actually from December 31st. I need to find this index. I kind of lost it. But we've gotten this base bottom here. We've seen this move back up here. We're getting a very good upward trend off of this deep, deep low. And this just goes to show you that historically, look, going all the way back to 2000, all the way through 2006, 7, 8, 9, the extreme lows, we've come back down into some extreme low levels. I mean, this was really the lowest level during the global financial crisis, and we got down to very close to those levels. It would not be surprising to see this reflate back up into this 1.0, 1.4 area, right over in this lower green area over the next year or so. So be prepared. We've seen a broad unwinding in the market. Those doom and gloomers that still think we're about to collapse into Neanderthal types of days, boy, I don't know. I just don't see it happening. I see capital creation, capital function, as long as the wheels stay on the train and the global markets continue to function. What should happen with this capital is it should find its way into the economy. It should start producing new technology, new services, new consumer engagement, higher GDP, higher economic function, and eventually work itself into wages. So I see this kind of moving up into a moderate reflation trade over 2 or 3 years. Bradley Custom Large Cap Index moving back up very strongly. This is the monthly chart. Really nice to see this basing and bottoming. Got a very strong engulfing bullish pattern here. We're nearing the end of this cycle, so it's good to see this move up. This could be a very good indication that we're very near or have already established a bottom. Remember, this is monthly, so the December 2022 lows would be here, and this is all January right here. Nice, solid reflation trade, and you can see it happens fairly consistently, where we get these kind of lows and then a bottom. A low and then an engulfing bullish. A low and then an engulfing bullish. At this point, this looks like a solid reversion trade back to the upside. Same thing's occurring here on the global asset index. Nice, solid, engulfing bullish pattern. Very solid for the bulls. Not so solid for those that are shorting or the bears. Very difficult to be a bear unless we have some sort of a crisis event. And so far, we've avoided that. We'll see how that plays out, though. Gold cycle monthly index accumulation is still taking place. Gold and silver have really skyrocketed, but they are stalling this week. If you haven't paid attention, they've pulled back a bit. Gold is down a little bit, silver's down a little bit, and that's what I expected. Remember, a couple weeks ago, I told you that I would not expect this to rally solidly. Gold, typically, I'll give you a little hint. Gold typically moves in $350 phases. So now plus or minus a little bit, everybody, but roughly $350 phases. So we've had a very solid $350 rally off of recent lows. And what I'm going to warn you again is that we're likely going to stall, possibly for a couple of weeks, find some new footing, and then attempt to rally up to roughly 2250, 2200. That would be the next rally of 350, let's say from, like 1918, 1920. If it were to go up $350, that would do, if I do the math real quick, that would put us around 2260, 2270. And that's a fairly safe guess as to what's going to happen for gold. So we just got to kind of ride out the accumulation phase. This accumulation phase is very solid. Normally we get a little bounce, then we consolidate, accumulate, we get a little bounce, consolidate, and accumulate, and then we get this real price appreciation phase, which is where price starts to really take off. Then we end up seeing some distribution selling coming, and then eventually we get up here with large amounts of distribution selling, and then we move back into this waning phase for gold, which is real distribution until we start to accumulate again. We're in the accumulation phase right now, which is great. Custom Innovation Index, big bounce at innovation. If you remember, back here in November, December, I was telling you that techs looked like a great opportunity to get set up in an anchor position. I don't know if any of you listened to me. But boy, oh boy, oh boy. I mean, I think Tesla's up like 30%. Technology sector has just really rebounded like mad. And the custom index was telling us that this was a great bottom down here, right in this area, an absolute wonderful base and bottom. And remember, everybody was telling you that markets are going to collapse, markets are going to collapse. Boy, oh boy. I mean, I don't know how to say it any other way. Look at that collapse. Yeah, I went from 47 to 67. That's a 50% rally over the last 3 weeks, and I just can't believe these doom and gloomers. Okay, anyway, fear index. Fear index is moving lower, 5.56. Wonderful to see this down below this lower threshold. And remember, these are 3 levels of fear that I use. This is the SPY starting to move higher in a buy trend, and this is the market sentiment index consolidating near this middle channel. Okay, now what does this mean, ladies and gentlemen? This means that we're not seeing a big breakout. We're seeing some accumulation, obviously, in technology and other sectors, but we're not really seeing anything but moving into kind of a flagging baseline formation right here, with fear diminishing. This is why we cannot get overly aggressive to the upside right now. If you're a conservative trader like me, maybe taking a couple of small trades, maybe getting into some anchor trades, running some stops, maybe looking at some options, maybe 30, 60, 90 days out. But long and short of it, ladies and gentlemen, we just don't have that real confirmation yet. We're getting solid basing. We're getting solid confirmation that we're in what looks to be a basing type of mode for the market, but we have yet to move above these previous highs. We have yet to see any real accumulation to the upside, and fear is diminishing. So we're kind of in a stage where it's apexing. This could be a false move. We could see more volatility. Remember, I don't expect anything huge. At this point, I mean, I would be surprised if we ended the year back up here in the 442 area, 445 area, 450 area. That would be a stupendous move 9-10 months from now, in my opinion. I don't think we're going to see anything big. I think we're going to see, and this is a great time for you to be waiting, patiently protecting, and begin some accumulation once we get some real confirmation of what's going on. Next, the real estate sentiment index. Real estate sentiment is collapsing. This is the most hostile we've seen real estate in forever. You can see here that the home price index, this is the U.S. home price index, has moved downward. I do believe that we are going to be looking at extended Fed pressure. The Fed could continue with a quarter 25 basis point or 50 basis point rate increase. I'm expecting basically a quarter to 50 basis points, but we could see 2 or 3 of those pushing this market into a downward cycle. You can see here historically, 2007 peak, we got into moderate hostile territory, and then as we unwound, we ended up down here in very opportunistic opportunity. This is an unwinding phase here. And this is an unwinding phase here of excesses in the market. This as well is an unwinding phase of excesses in the market in real estate. And this again was excesses in the market unwinding to an extreme optimistic level. Now we've seen an extreme hostile or pessimistic level. This needs to move all the way back down into this lower channel here, which would likely prompt a move on the home price index back down into this 315 to 275 level, somewhere back over in here. So again, we're just waiting right now, and I think the Fed has the power to do so. I think the Fed really does have the power to, go another 50 basis points or 100 basis points and really, put interest rates up in the, for homes up in the 8, 9, 10% rate. And that could be something that really takes the wind out of price appreciation. So we will see what happens. Technology ratio chart. again, was telling you for months how this basing and bottoming level back to 2013-12 levels was really unprecedented, undervalued technology. I mean, you can go on YouTube and watch my videos from October and November, even earlier. But long and short of it, ladies and gentlemen, here's the bounce. There you go. All those doom and gloomers telling you that the market's going to collapse. And now you have a scenario here where you've got a solid 15 to 25% rally phase here. Just incredible move in technology over the last week or 2 weeks. Global U.S. U.S. to global market index. Again, the global markets are reverting higher faster. This is basically global markets versus U.S. They are reverting higher, breaking the channel faster than the U.S. markets. We've seen this happen back over here, 2017. You can see after COVID, we had a different type scenario where the U.S. markets reverted pretty much equally with the global markets and then eventually extended higher. At this point, we might see the global markets move back up into this level, which would be another 10, 15% higher. And the U.S. markets, they need to move. They need to revert back up into the 70, 75 area. That's kind of where I think we're headed by summertime. So we got another maybe 8, 10% to the upside. This has got maybe another 8, 10, 15% to the upside. Kind of right into this middle area here for the global markets and right into this 75, roughly 80 area for the U.S. markets. And that's kind of where I think we're going to start Q3 and Q4 of this year, right in this middle area. I think we're just going to revert back up into this 50% area, stall out come June, July, August, and then we'll start to see what happens near the end of the year and possibly move a little bit, 6, 7, 8% higher. Remember, 2024, as soon as we get close to 2024, we are going to be in election year ranging. So you need to understand that the next year and a half, 2 years is likely going to be fairly stagnant as far as trending. Okay. U.S. custom valuation trend index pulling up, but we're not seeing the valuation trend index show the same strong upward trending like we saw in technology. This is good. This is basing. This is telling us that we're looking for a potential bottom. We do need to see this move higher. We do need to see this move off of this level for hopefully a couple of months and try to move away from these extreme lows. This looks like capitulation, basing, bottoming to me. I would definitely want to see this try to move upward through January, February, March. Hopefully back up into this level here. Let's call that 2.25, 2.2. That would make me very happy as far as a basing, bottoming type of mode. The U.S. leading market index really is moving higher again. This is a custom index that measures how we're coming off of this bottom. You can call this a deep V bottom, but notice how it led the market. We had lows in December back over here where the U.S. leading market index had moved up from 1.45 up here to 2.1 roughly. So this really led the market. Same thing here. Notice how it rolled over back here in June, July, August, and rolled over well before the peak in the SPY. So now that we've gotten back up to this level, this 2.18 level, I think we're going to see this really just kind of stall out, stay in this range over the next 3-6 months, maybe a little higher, maybe up to 2.4, maybe up to 2.45. But in reality, I think it's just going to stay muted, upward trending, nothing big, nothing exciting unless, you know, something really breaks. But I think that we're really looking at just kind of a 7, 10, 12% upward move throughout the rest of this year, maybe 15%. I think it's going to stay fairly muted, kind of dance around these upper levels, kind of like it was doing over here, and just dance around these upper levels. This was, remember, 2019. We had a big rally in the SPY, but it didn't really reflect here like this. So we could see this index staying in this upper channel while the SPY moves up to, you know, 420, 425, 430, 440. But again, we've reached kind of upper extremes here, ladies and gentlemen. Unless I'm reading it wrong, I think we're going to see some sort of a consolidation back down here to the 185, 190 area, and then continue to consolidate sideways. Volume ratio index, it looks like we're seeing some real accumulation at the beginning of the year. Remember, we've got a ton of people that are working and contributing to their 401k, and it's the end of the year. A lot of that money is being redeployed right now, so there's going to be some money putting back in the major indexes and the major ETFs and stocks, but there's also going to be a lot of money that's sitting there patiently waiting for the next big opportunity, not willing to take risks right now. So I would like to see some spikes like these, but we just don't have them yet. Next, the commodity to gold index, big move here, not huge, but we are seeing a bit of a reflation trade with inflation, meaning that inflation is picking back up again. Feds may do something to try to stop that. This could just be reactionary to the end of the extreme low and end of 2022. We need to watch how this plays out. It would be good to get up into this 2.0, 2.2, 2.4 area and stay up in this area throughout the rest of this year. That would indicate that, as long as we don't get above, say, 3 or 4, that would indicate that traders are back, the economy is strong, and we're doing okay. But again, if we were to move into this area, kind of like right over in here, and stay in this area, this is moderately strong economic growth that the Fed doesn't have to worry about. We start getting above 4, like up in this area, this now becomes bubble territory. And we got to be very cautious of an extended bubble. So if we were to get up into like 3.3, 3.5, that would be okay. That would be a little hot. Fed would probably be looking to cool things down. But up above this level, 5, 6, boy, that's bubble territory. And the Fed may not like that given what they're trying to do right now. Custom metals trend index, here's the pullback in gold I told you about. Could come all the way back down to these levels. And this clearly shows the $350 dollar rally. So from basically here, you figure 9,500 to 12,500. Do the math. That's 3,500 points roughly, or 3,000 points. 9, 10, 11, 12. Yeah, 3,000 points. So hypothetically, there's your 350% move, or $350 move. There's your $350 move. Here, from these lows up to here, roughly, is a $350 move. From these lows to here is a $350 move. This is what I was telling you. From these lows to here, up to here is a $350 move. You get these common $350 moves in gold. I call them phase moves. And now we've had that move take place. Now we need to see it pull back. Probably going to end up back here, 11,676. So that would, if I took a guess, I would say 1910 to 1885 maybe. And then it's going to base around that 1900 level and move up to 2250 in the next phase. FANGs index, basing and bottoming. I question this black bars all the time, but the reality is this is valid. And what happens is this is a custom index where we're consolidating multiple symbols. We are seeing upward trending. We're just seeing it in a consolidated, muted type of format. And that's because some of these are moving lower, some of these are moving higher. But again, folks, FANGs index is basing and bottoming, which is solid. Custom metals index chart, I thought we were going to get back up into what I call the yellow brick road, these two yellow lines. We've stalled out here. We'll probably have a couple of weeks of sideways trading, maybe 30 days. And then we'll move back up into the upside with the next $350 phase. So you can see here from 360 low up to 440. Do the math real quick. That's about 360, about 80 bucks. So if we look at this on a custom index, about $80 move, call it $80 to $90 move. We've had an $80 to $90 move. We stall out here. We move upward from roughly 420, 425. That puts us up into the 500 range, way up here to 510 range. That would be outstanding. And that's exactly what I think is going to happen by June, July, August. Okay. Custom index chart. This is again the global index, very strong reflation trade. Broke through this level, broke through new highs. We've got very solid trending to the upside. This is a unique high price level plus a gap here. We broke above it. This was technically right here our bullish trend indication. The global markets are in a bullish reflation trade, and that is going to drive a lot of upward pressure in the U.S. markets as well. Okay, the rotational modeling system, nothing has changed. We are still, this is a slower system. We really need to wait for confirmation here. Weekly is bullish, daily is bearish, net 50% short cash or short 50% cash. We are off 1.44% in that current position. If you had two separate accounts, which is what I try to do, then you have a net 25% long position from 6/10/2020 is up 27%, and you have a net short position from 8/31/2022, which is off 1.44%. The rotational modeling system trends have not changed this week. Everything is still the same. Our allocation is still the same, 20% stocks, 55% cash, 25% metals. Remember, metals are acting as our hedge right now, and they're going to continue to act as a hedge for the next 5 to 8+ years. Stocks, 20% cash, stocks, 80% cash, and the alternate, this is if you cannot hold metals. So again, we're really very well protected. We're only technically trading 20% of our stocks, our capital into stocks, and our 80% is into cash. Now, how this works is really simple, folks. Okay. This is your retirement account. If you have a 401k or an IRA or whatever in your retirement account, this is what you should be doing with it, which is 50% short, 50% cash. When I say cash, that means moving into something that's safely protected, like government bonds or low risk instruments, something that's maybe tied to the US dollar or tied to bonds. That's what you're doing here. And then, of course, if you can, you want to move into something that, you know, essentially is bearish. So again, nothing that's tied to the S&P or technology. You want to essentially try to find something that's expecting some sort of a downward or flat move in the market. A lot of times with these Roth IRAs, you can go bullish and bearish, you know, betting that's going to go up or down. So this would be a 50% bearish trade, 50% cash, and that means either in nothing sitting in cash or in something that's tied to, you know, potentially something safe. That would be a low risk type of environment. Now, when you're coming over here and you're looking at this, this is your alternate trading account. So understand that one is your retirement account, your 401k, your IRA. This is your smaller trading account. And I recommend this should be about 10% or 15% of your retirement account. And this is where you can trade all you want, become an active trader, swing trade, day trade, whatever you want to do. And this is to try to gauge how you want to protect your capital as a trading account. You could hypothetically take some of this and apply this to the IRA 401k account. So these allocation levels are dynamic. I set them as I'm reading the markets, and they're designed to protect your capital more efficiently than actually just running, you know, with your head against the wall, trading 100% of your capital all the time. And remember, the rotational modeling system, this result is based on 100% of your capital, your 401k or IRA capital being deployed in this manner. So all of this is basically saying, look, if you have a retirement account and you follow the MENT rotational modeling system 100% of the time with 100% of your capital, then this is the type of results you will generate. If you go with a smaller amounts of capital deployed, then obviously you're going to see smaller gains in some points here. But the way I run it is 100% invested all the time. It's a rotational modeling system. And when I say invested all the time, that means we could be in cash. We could be, you know, long in one account, short in another account, which is net offsetting one another. but essentially the rotational modeling system is always trading. It's never setting completely flat in the market. Okay. Next, we have the U.S. stock market index moving out of this breakout apex. I mentioned to you last week we had this apexing formation. Apexes can be extremely volatile. So pay attention, folks. We could see a next couple of weeks, a downside move, consolidation. Really, I'm going to warn you right now, do not get overly aggressive to the upside right now. We are not anywhere near comfortable with this basing bottoming. We could see this spin out of control for the next 2 or 3 weeks with whatever news is coming. Apexes tend to be extremely volatile. Next, the custom valuations index chart didn't show any real growth last week. So understand, even though we see an inflation pop up and other indexes pop up to the upside, this is telling us that real valuations here, folks, have stalled out. We're not seeing any real valuation appreciation in the market yet. So this is likely a reactionary price trend, probably driven by technology sector and metals and others. So be aware that we're not seeing any real follow through here. This is kind of like saying, oh, the crowd jumped up and went crazy, but there's really nothing going on. And that's kind of what's going on here. Okay, lastly, the volatility index. Big move up to 1150. This is just like I told you. It looks very good right now, but this again is probably going to stall back out to the downside right around this 10, 9.5, 10 area. I do expect this to kind of migrate in this area, not shoot straight up here. Okay, guys, that's it for now. It's a little long. Welcome to MENT.com. Follow along. Please come back over here. Visit MENT.com. Decide if this is really what you want to do. I'm trying to give you the best advice I can. I'm putting hours into this every weekend to try to deliver all of these updates for you. I would appreciate it if you can come and take a look at what I'm doing and support me in my research. It's really, I'm trying to make it as cost effective as possible. I'd love to, honestly, I'd love to have, 1,000 or 2,000 members following me and really using this to the best of the ability. I mean, I really do see that most people really don't understand what I'm doing. So pay attention. What I'm doing is I'm giving you all of this incredible research. I've just highlighted what to expect for the next 2 or 3 months, literally 2 or 3 years. I'm giving you the live trade setups, which are incredible trade technology set up right here. You just got to get in here and use it. And then I'm giving you at the same time the expert growth membership with all of the updates and everything else here. From my perspective, I'm giving you daily, weekly, monthly, quarterly, swing trades, investment trading. I mean, I'm giving you the whole gamut. All you got to do is come in here, figure out how to use it the way you want. Like I tell everyone, I do the research, you make the trading decisions. Just like it says here, I do the research, you make all the decisions. I'm not here to tell you, every day, every hour what to trade. My goal is to teach you to become a trader and use the tools that I see and I use to become more efficient at understanding risks, opportunities as they come in the market. All right, guys, that's it for now. Off to the next video.